Hello and welcome. So you're looking to grow your wealth here in the Indian market? And you've probably heard the term mutual funds thrown around a lot. But what are they really? And how in the world do you choose the right one for your goals? Well, in this explainer, we're going to build a clear roadmap for your entire investment journey.
You know, the world of investing can feel, well, pretty overwhelming at first. You've got market ups and downs, endless news cycles, and just countless options. It's so easy to feel lost. But don't you worry. We're going to break it all down step by step and give you a clear map for navigating the world of mutual funds. All right, first things first, we have to start with a solid foundation. Before we get into all the different strategies and types, let's just answer the most basic question of all. What exactly is a mutual fund? Think of it like this. A mutual fund is basically a big shared basket. Lots of people, investors like you and me, put their money into this one basket. Then, a professional, the fund manager, takes all that pooled money and buys a whole variety of investments, stocks, bonds, you name it. You get to own a small piece of that entire basket, and that piece is what we call a unit. Simple as that. So why is this basket approach so popular? Well, for one, you get an expert managing your money right off the bat. You also get instant diversification, which is just a fancy way of saying your risk is spread out. Plus, there are economies of scale, kind of like buying in bulk, which lowers costs. And maybe best of all, you can start with a pretty small amount of money, which makes it super accessible for just about anyone.
Okay, so now we know what a fund is. Let's look at the blueprint. How do these things actually operate? This really comes down to their basic structure, and that affects how and when you can put your money in and take it out.
You've basically got two main types here. First, open-ended funds. These are the most common. You can buy or sell your units on any business day, which gives you a ton of flexibility. Then you have closed-ended funds. With these, you can only invest during a specific launch period, called the New Fund Offer, or NFO. After that, if you want to buy or sell, you have to do it on a stock exchange, just like a regular share. The big difference here is liquidity, which is a really key factor depending on what you need from your investments.
So we've covered the structure. Now let's peek inside the basket. Where does your money actually get invested? This brings us to the different types of funds, which are usually defined by the assets they hold.
First up, we have equity funds. These funds primarily buy stocks, which are basically shares of ownership in companies. The main goal here is growth, making your money grow over time. Now, because they're tied to the stock market, they do carry higher risk, but they also have the potential for much higher returns. These are usually a good fit for your long-term goals.
Next up, debt funds. Instead of stocks, these funds invest in things like government and corporate bonds. You can think of these as making a loan that pays you interest. So the goal here is stability and generating a steady income. They're generally considered a safer, more conservative choice compared to equity funds.
And what if you want a little bit of both? Well, that's where hybrid funds come into play. Just like the name says, they invest in a mix of equity for that growth potential and debt for stability. It's all about trying to find a balance between risk and reward, all in one fund.
All right, so you've chosen your basket type, equity, debt, or a hybrid. But who actually decides which specific stocks or bonds go into it? And maybe more importantly, how do they decide? This very question leads us to one of the most fundamental concepts in all of mutual fund investing.
This brings us to the architect of the fund's whole strategy, its management style. We're talking about the absolutely crucial difference between an actively managed fund and a passively managed one.
And I really want you to listen closely here. Understanding the difference between active and passive management is one of the most important things you can do. It affects everything: the fund's goal, its performance, and, maybe most importantly, how much it ends up costing you. Let's break this down. In an active fund, you've got a fund manager who is constantly making decisions, buying this, selling that, all with the big goal of beating the market. Now, in a passive fund, there's no active stock picker. The fund simply aims to copy or mirror a market index, like the Nifty 50. Its goal isn't to outperform the market, it's just to match the market's performance. And because of all that active work, active funds have higher fees, what we call expense ratios, while passive funds are much, much cheaper.
Now, this is a really big deal for investors. Think about what this means. You're paying a higher fees for an expert to try and beat the market, but the data consistently shows that most of them actually fail to do that over the long run. Those higher costs just eat away at your returns. This is exactly why so many investors are now realizing that the cheaper, passive approach of just matching the market often leads to better results in their pocket.
Okay, we've covered the what, the how, and the why. Now for the part that really matters.
How do you apply all of this knowledge to find the right fund for you? Let's put all the pieces together.
Before you invest even 1 rupee, you've got to go through this checklist. First, define your goals. What are you saving for? A house in 5 years or retirement in 30? Second, be really honest about your risk tolerance. How would you feel if your investment dropped by 20%? Your gut answer helps decide if you should lean more towards equity or debt. Third, what's your time horizon? The longer you have, the more risk you can generally afford to take. And finally, and this is a big one, always check the costs. A lower expense ratio means more of your money is actually working for you.
And it's just as important to know what not to do. Don't invest randomly without a plan. Don't just chase last year's hottest fund. What goes up can come down. Also, try not to own too many funds. That can just dilute your returns and make things complicated. And most importantly, do not panic sell when the market gets a little crazy. Staying disciplined is really the secret sauce for long-term success.
At the end of the day, for anyone just starting out, mutual funds are just an excellent tool. They take away the pressure of having to pick individual stocks, they give you professional management, and they really encourage a disciplined long-term way of thinking about building wealth. It's a structured and forgiving way to get into the markets.
So, there you have it. We've laid out the basics, the structures, the key strategies, and a checklist to get you started. You officially have a map to help you navigate the world of mutual funds. So the only question left is, where do you want to go?